Please welcome your panelists for the evolution of hedge fund management, moderated by Bloomberg TV's editor-at-large, Erik Schatzker.
Good morning, everybody, and welcome to the evolution of hedge fund management here at the Milken Institute Global Conference 2018. I'm Erik Schatzker. Great to see you here. I think we're going to have a very interesting, I hope provocative conversation today. Instead of introducing our panelists, I would say first you can read about them in your program. However, the bios, while informative, are incomplete, and I thought it would make sense to help establish some context and give you a better idea of who's on stage with me for our panelists to introduce themselves and tell you a bit about what they do. Why don't we begin with you, Dawn?
Sure. My name is Dawn Fitzpatrick, and I'm the CIO of Soros Fund Management. We run George Soros's family and foundation money. We invest across asset classes and across geographies. About 70% of our money is managed directly internally, and about 30% we invest through third parties.
Ricky.
Hi, Ricky Sandler, founder, CEO, and CIO of Eminence Capital. We run a $7 billion investment management firm, about $5 billion of which is long-short equity, traditional bottoms-up stock pickers, a dying breed, but surviving.
Maybe thriving.
What? Well, I think it's coming. That's part of the evolution of the industry. But bottoms-up stock pickers that run with a healthy balance sheet on both the long and short side, globally invested, and we've been in business for 20 years.
Andrew.
I'm Andrew Feldstein, the co-founder, CEO, and CIO of BlueMountain Capital. We manage a little over $20 billion. The vehicles that we manage range from hedge funds to opportunities funds that invest in less liquid opportunities. We manage about $10 billion of CLOs, and then we manage a number of single investor funds where for large investors we put together all of the pieces that we manage. Our investing capabilities range from quantitative equities to structured credit to volatility strategies to distressed discretionary equities, all the way through to less liquid opportunities in private debt and private equity.
And finally, Dmitry.
Dmitry Balyasny. I founded Balyasny Asset Management in 2001, which seems about 300 years ago in hedge fund terms. We have about 10 billion in AUM, 600 people spread around the globe. We started in long-short equity and have expanded over time into macro fixed income, commodities, credit, and quantitative strategies. Most of the strategies are market neutral or close to market neutral, and we focus on uncorrelated, consistent performance.
So as you can see, and as you've heard, there's an extraordinary range of expertise and depth of experience on this panel. To give you a sense of what we hope to accomplish over the next hour, we're going to explore the pressures and demands on hedge fund managers and try to give you a sense of how the industry is going to respond and what opportunities might emerge as those things evolve. A question I'd like to begin with, which I think will help us flush out all of the key issues, is this one. Is the hedge fund model broken? Dawn, you've been an insider in the hedge fund industry. Now you are, of sorts, an outsider, given that you're at Soros. You're also a client of the hedge fund industry. What do you think?
I don't think it's broken, but I think the 2 and 20 fits all model definitely is behind us. I think investors have gotten way more sophisticated in terms of separating out kind of simple beta from an excess return that's differentiated. And I think they're also very focused on alignment here. So I think you will see not just, fees don't necessarily have to just compress, but things like slower crystallization of performance fees, management fees that go lower as assets go higher. I think things like that will matter more and more. But in terms of backdrop, and Ricky touched on it, the excess we're seeing in strategies like long short right here are really interesting as we see a lot of dispersion in stocks. And I think as markets become more challenging, our skills will become kind of more in favor.
So if Don's right and the model's not broken, I want to hear from each of you on what, if anything, is wrong with it. Andrew?
Well, I'm going to gloss over a metaphysical question, which is, what is a hedge fund? Because I think it has different meanings for different people, and I'll just sort of take the question as asked. If you think about investors' preference for non-commoditized returns, and let's just not use the charged word alpha for a minute, but non-commoditized returns. I think that there are a number of constructs of vehicles, of alignment structures, of fee structures that will enable investors to hire managers to seek for them non-commoditized distinctive returns that aren't easy for everybody to achieve. And so if the question is, are people going to stop seeking those return streams? I think absolutely not. In fact, I think people more and more will seek those return streams. But I think Don's exactly right. The way you structure your relationship with the people who seek those returns for you inevitably is going to change.
Dmitry, Ricky, what about you guys?
I'm going to take the answer from a slightly different angle, which is sort of, is the return stream broken, and is the construct between investors, because ultimately is the model broken? There's some discussion here about is the fee right, and there's some discussion about why has the industry underperformed investor expectations.
You're right.
And I think which is causing investors to ask whether it's broken and whether they should pay the fees. And I think, frankly, the title of this panel sort of talks about it, but the evolution of the industry has created certain constructs that have actually created the lack of return in the industry. And by that I mean the industry first went through an institutionalization which was great for it, and everybody got compliance and best execution and all this stuff. And then the financial crisis hit, and that created a different construct between investor and client that changed the whole dynamic. We used to be able to get high returns with limited volatility. And then when the financial crisis hit, that limited volatility got questioned, and investors began to push us to protect downside volatility rather than make them money. And that created a construct where both portfolio construction within the long-short equity industry and frankly, risk management, and I'll call that the de-risking periods that we've had since then, the job, it appeared to be, for the hedge fund manager was to not lose you money, not to make you money. And that actually sowed the seeds of very mediocre returns at high fees, which is part of the problem.
I also think part of the problem there was you had managers become asset gatherers more than focusing on the returns they delivered. So part of that lower volatility was a fee maximization game.
Dmitry?
Yeah, I agree with a lot of that. I mean, we get a question a lot of, why do you have 600 people, right? And I think it speaks to the challenge in really generating consistent alpha and how capacity constrained it really is. So we find that having a focused team in a fairly narrow specialty where they could be world-class and hopefully amongst the best in the industry in their particular niche, and have 500 million, let's say, of capacity in that particular strategy, that's a much more replicatable, consistent alpha-generating strategy than a person or a team running lots of different strategies and with much larger assets. And so if you sort of buy into that, then you need lots and lots of people, each trying to get a small slice of the alpha. And then when you can combine that with capabilities and and risk and quant and recruiting and management, and take that off of the portfolio managers, that's sort of one way to go about it. But it's very very capacity constrained by definition. Like anything that has high alpha content is going to attract lots of smart folks to go after it. So if you can find more narrow slices, it's a more consistent way to go about it.
I think I understand what Dmitry means when he says alpha, but you described alpha as a, what did you say, a loaded word?
I think I said it was a charged word.
A charged word,
Yeah.
why?
I don't think there's a real good definition for alpha, mostly because there's not a real good definition for beta.
Ooh. Is it too much of a rabbit hole for us to try and do that here?
I think so.
Okay. Don, you and Ricky raised together a provocative point that there's more to the underperformance. Let's call it a disappointing performance. Yeah. Seems a little less judgmental than poor. By hedge fund managers collectively, the industry collectively over the past decade, certainly in the post-crisis period. Ricky, you highlighted the demands perhaps placed upon hedge fund managers by their investors, changing set of demands, changing set of expectations, return of capital as opposed to return on capital perhaps. Don, you talked about growth for growth's sake, if I could summarize it that way. What else belongs on that list? Are there other things that we should put on the list that explain why hedge funds collectively have not done as well as their investors either hoped or expected?
Jump in on that. So there's $3 trillion in the hedge fund industry, right? And so if, let's just, without arguing too much about the definition of alpha, let's just say that investors expect say a 10% return in aggregate, and most of that should be alpha on that, right? Is there $300 billion of annual alpha to be pulled out of the markets, right? I would say no, right? I don't think it's anywhere near that. And so you have everybody fighting over a fairly limited alpha pool, and a large chunk of that pool goes to a small number of the largest firms with capabilities and lots of different strategies. And everybody else is kind of fighting over the rest, right? And so I think from the investor side, you have to think about what you're trying to really invest in, like what type of return stream. And that one isn't necessarily better than another. It's just being clear on what you're buying, and they should have different, different fee structures and different, challenges to generating those returns. You could buy a smarter long bias type of return stream. You could buy a market neutral alpha type of return stream, and they come in different amounts, and they should have different prices.
I'm going to disagree with Dmitry a little bit on the alpha opportunity. I think the alpha opportunity in the market is as good as it was 15 or 20 years ago. We've done work around the percentage of stocks that outperform by 20% or underperform by 20% or more, and sort of what the spread is between the 80th percentile and the 20th percentile, and the opportunities there. What I like to say is it's different. And that means that the players in the market are different today than they were 15 years ago in pre-crisis. And those people are help setting prices. And our jobs as fund managers are both to get all the fundamentals right and figure out where the businesses are going over the next 5 years and what they're worth, and also to figure out what the market's going to pay for that stream and that narrative. And that is different today than it was pre-crisis by a lot.
Could you be a little more, go ahead.
To Ricky's point, I think one of the kind of things that's changed very materially is kind of the growth of passive. And I think part of hedge funds alpha historically was that we had this, another active investor in the market that hedge funds were clearly one step quicker than. And an easy example is back, 10 years ago, you would see big mutual funds trade very sloppily, and that was actually a really good source of alpha for equity hedge funds, because you would buy that block and at a good discount, and within a matter of a day or two, you had a gain to show. I think right now, and this speaks to Ricky's point, I think he's right. There is good dispersion, and winners, go up a lot and losers go down, but you have to be more patient. And right now, it feels like investors are very patient with their private portfolios, but when it comes to their public market portfolios, it's what have you done for me lately?
I think we should be at least mention that there's a cyclical element here as well as possible secular elements. Since the crisis, we've had very easy money. And easy money has created liquidity, and that's bid up asset prices, and it has been hard to generate really distinctive returns versus whatever you want to call the market in that kind of environment. That may be changing, it may not be changing, but that is more cyclical than secular. There are secular things going on as well. I think Ricky mentioned institutionalization, which by and large has been very good for our industry. And it's come from more sophisticated investors. It's come from just the natural maturation of the market. It's come to some extent from regulation. But one of the things that it has brought to the market is an expectation of specialization that I think to some extent undermines the purpose or the goals or the strengths of the institutions that we all run. If what we're trying to do is generate non-commoditized returns, and we strike upon some kind of alpha that we can extract from the market, one thing I'm pretty sure about, especially today, is that tomorrow that will start to commoditize. Capital will flow to it, labor will leave my institution and go to another institution, intellectual property is not that easily protected, and the non-commoditized returns will start to commoditize. So what that means is if we want to stay ahead, we need to change, we need to adapt, and maybe the only persistent alpha, if you will, in our industry is the alpha from adaptation. It's building cultures and institutions and organizational structures and investor relationships and investment in technology that allows you to constantly stay at the frontier. And if you don't constantly stay at the frontier, you become a commodity return provider, which, as Dmitry said, I think is incredibly valuable, but ought to be priced differently. And so part of institutionalization, and one of the things that we at least really try to educate our clients about, is that you want us continually pushing the boundaries, which in some ways is contrary to the goals of institutionalization, which tries to create efficiencies which are very understandable in the contracting relationships between principals and agents.
Yeah, I agree with that, and I think one of the other edges that is available is pushing your capabilities across different strategies. Like once you've built out a particular capability, whether it's in quant or risk or long-short stock picking, whatever it is, it does translate a little bit to giving you an edge in the next tangential strategies. So, we got pushback over the years from clients as we expanded into different areas, but and some worked and some didn't. But over time, some of the best returning strategies and some of the best returning teams were ones that weren't around 5 years ago or 10 years ago at our shop. And if we would have passed on those, we would have missed out on a really good uncorrelated return stream. I think it also speaks to the number of hedge funds that you really need in the world to kind of access the strategies. Because if you have if you buy into the point that business capabilities and management capabilities and infrastructure are really important, it's very hard to have 10,000 funds that can kind of do that, right? And the folks that kind of perennially have good, consistent returns tend to not turn over that much, right? So I used to run a fund of funds with Partners Capital for a long time, from the 90s through about 6-7 years ago. We had money with Ricky back in '98, right? And here we are still, right? It's 2017. There's a lot of persistency in the top managers and top, kind of business folks that I think is contributing to the consolidation in the industry.
Dmitry, I don't want to spend too much time on this point because it has been debated before, but since you've introduced it twice, I want to at least ask you if $3 trillion of hedge fund industry capital is too much, if 10,000 funds is too much, if the quantum of alpha that can be generated in a given year is not 300 billion, what is it? What's the right size for the industry?
Well, I think it depends on what your definitions are. So I think 3 trillion of alpha-seeking assets, of pure alpha uncorrelated seeking assets is way too much, right? I think there might be a couple hundred funds in the world as opposed to 10,000 that can consistently generate alpha, if that, at scale, right? But that doesn't mean that there's not a legitimate, business purpose and a potentially valuable return stream for clients, but they just have to have a different definition. So whether it's relative performance over a particular index, a long bias, a smarter way of gaining exposure to something, that you can do in a hedge fund structure than in a non-hedge fund structure, that's fine. But it can't all be, one type of hedge fund fee model and one type of alpha-seeking return, claiming that we're all going to generate uncorrelated returns of $300 billion a year. Like that, right?
Is that kind of what you were getting at with the definition, the metaphysical point about the definition of hedge funds?
It's much more of a continuum. And the reason I suspect all of us at the core are in business is because we have fewer constraints than other participants in the market. And I'm not criticizing constraints. First of all, I think they're very necessary for efficiency, and second of all, they keep us in business. But to put an artificial stake into that continuum somewhere, to make it easy to talk to people and to organize yourselves, remember, it's artificial. And whether that's a stake between debt and equity, or a stake between liquid and illiquid, or a stake between hedge fund and something else, or a stake between alpha and really, really smart beta, they're all stakes in the ground that are artificial. And so I can't even answer your question about whether $3 trillion is too much or too little, because you can't bound it. I do know that there's, I think, $85 trillion of investable assets in the market now, and predictions are that's going to well over $100 trillion within a few years. And the markets are constantly changing, the structure is changing, the participants are changing, technology is increasing, data is changing, different sectors are rising, different sectors are falling. There's always going to be, if you're innovating and adapting, something to do that is non-commoditized. And if you define it that way, $3 trillion is a drop in the bucket. Ricky mentioned, or Don, I don't remember whom, mentioned the transition to passive, and what does that mean? And it used to be so much fun to trade against mutual funds. Well, it still is sort of fun to trade against mutual funds, but it's fun to trade against passive too, because passive is another metaphysical puzzle, right? I had an investor ask the other day, what's a better hedge? The S&P, CDX, which is a credit derivatives high yield index, or HYG, which is a high yield bond index. I said, well, they're all really different. The S&P is chock full of technology companies, low risk companies. The bulk of the market cap isn't very levered. HYG is a very broad-based high yield index that happens to have interest rate risk and call risk in it. And CDX is just a spread index with many fewer names, about 5% of them about to default. And so if you think of these things as interchangeable, all of them passive, excellent. Because that means a lot of other people are thinking of them as interchangeable, and we get to go in and understand what the constituents actually are and trade against the people who think they're trading passively, but are actually making active decisions about what passive means. So I just think the industry is constantly changing, and if you define it as generating returns that aren't commoditized, that aren't easy, by doing things that others are constrained from doing, then I think $3 trillion is just way too small an estimate.
And one comment I would make, Dmitry talked about kind of the bigger platforms being able to connect dots. And Andrew talked about kind of being able to evolve. When you actually look at hedge fund flows, those big firms that can connect the dots are doing well. And I believe wholeheartedly what Dmitry and Andrew said, that's valuable, but that field is narrowing. So, and the flows in aggregate are not going to those bigger firms. It's what you've seen lately is flows go to the $250 to $500 million hedge funds that are more niche-y, and I think that goes back to being able to deliver a differentiated return, especially when you're at the top of a market cycle, and you want kind of not just line item diversification, but actual return diversification.
We have the seeds of a debate here. On the one hand, we've heard about the need to evolve, the need to diversify. On the other, we've heard just now that specialization may actually deliver better uncorrelated returns, or if we like, alpha.
I think it's barbell.
Yes.
Barbell is what I would say.
I think for periods of time, specialization works, and I think you need specialization within a larger firm, and you need that step-back perspective, because as Andrew said and Dmitry said, I think the reason that at least the three of us have been in business for over 15 years is because we have adapted, we've realized the world's changed, and we have to keep building and evolving our firms. And so there's, in my view, there's part specialization that you need. You need analysts that know industries and information and what's important in a stock and in a business and can gather data and analyze it. And then you need somebody that can also step back and have sort of a more generalist perspective. At least that's the model that we pursue. And to us, that is one that could constantly evolve.
How much freedom do you have to evolve, to change, to adapt, if you will? Ricky, you made the point earlier that one of the problems with hedge funds as an industry is that they're responsive, and to a degree they should be responsive. They answer to their clients. But if the clients want to put hedge funds in a box,
Yep.
and the consultants, furthermore, want to put hedge funds in a box to make it easy to market those hedge funds to their ultimate clients, the LPs, how much room is there to maneuver?
Well, like, I think it comes down to your communication with your investors. I think the one thing that we have to do is do what we say to our investors. And what is that? I think if investors come in and are horrified that you could have lost 18% in 2008, you have to push back on that and say, I don't know what you thought this fund was going to do. And we have to be true to the return stream that we think we can deliver, the risk and the reward, and what flexibilities we're going to use to kind of do that, and how we're going to evolve. And so it comes down to a constant communication. I think we talked a little bit about the institutionalization. One of those things is transparency. And transparency doesn't just mean at the position level. It means at sort of the leading thought level of here's where we're going, these are the things we're doing. And I think ultimately the investors have to trust our judgment, but we have to communicate it well and make sure that they understand what we're doing.
Yeah, I agree. It's about communication. It's about setting the right expectations. It's about picking the right clients. Clients who want to be long-term business partners, not just short-term investors. I'll pick up on the seeds of your debate. I disagree. I'm not exactly sure that Dawn meant it this way, but I disagree with I think her point about the small niche funds, and agree more with what Dmitry was saying about a wave of consolidation. It's really expensive to have a sustainable organization trying to achieve the things that we're trying to achieve. And it's only getting more expensive. The importance of technology is only accelerating in our industry, like all industries. The importance of data and data science. The importance of being able to innovate in a more competitive market. You have to innovate faster. You have to innovate across a wider space. You have to be able to dial down your activities in one area, dial it up quickly in another area, only to dial it back up in that first area at a moment's notice. Well, that means you need to have a diversified team of people and a diversified set of capabilities and infrastructure, and you can't carry that with a small fund. It's not economic for the owners of the fund. So I agree with Dmitry. I think, I'm not surprised that he has 600 people. I think it's a great strength of theirs. I will not be surprised to see continued consolidation. And I think that the firms that succeed are going to be the ones that figure out how to scale without losing that ability to innovate, because we all know that there is a tension between scaling and complacency, or scaling and losing that innovative edge. And so one of the things that we focus a lot on is how do we scale to be able to meet the economic demands of the industry that we're in, while at the same time retaining that ability to constantly evolve and innovate.
Yeah, I sort of think of it like the private equity evolution over the years, where when it first started up and it was a successful strategy, you had hundreds and hundreds and hundreds of private equity firms, and then it's really consolidated, and you have a small number of firms that own a very large part of the market share, and then you do have lots of smaller niche firms, but the vast majority of institutional dollars go to a small number of firms that have capabilities that they leverage across lots of different sub-strategies in the space. I think we're all on the same page that specialization is really helpful to generating returns. The question is, like, how do you come up with a construct that gives people the wherewithal to really focus on their investing and have the resources to specialize and the consistency of the capital base? Because the other problem with a small fund, besides the business distraction of investing and running the business, is the unstable nature of it. Right? If you only have one strategy and you're specialized in your niche, right, that's great when that strategy is in favor and there's lots to do. But the following year there isn't as much to do and it's out of favor and returns might not be as good. And so what do? And if you need the infrastructure and the management and the technology, et cetera, you need the ability to invest in that. So to invest in it, you need more assets, right? And so then you're pushing back against your whole capacity-constrained specialization, and now you're hiring people in different strategies or expanding into other areas, and the performance inevitably goes down because that's not the core skill set of that manager. And if you don't do it, then it's a very unstable organization. So like we have lots of specialists, and every year we have a top 10 performer dinner, and the attendees of that dinner are very different every year. Right? There might be like 1, 2, or 3 that perennially come around, but the vast majority every year are different from the prior year, and it's very hard to predict who's going to be there, the following year. Right?
Could I just pause for a moment in the hope that the person back here who's sorting cutlery can hear me? Could we stop sorting cutlery? Okay.
That was value add right there.
Yeah. I don't know if you guys can hear it, but it just got louder, so. I think they did hear you, but they're protesting.
My kids do the same thing. I was going to save scale for later, but I think it's worth polling each of our panelists on this question of scale. You're right, it is getting more expensive to run a hedge fund, not just because of regulatory and compliance demands, but also, as you mentioned, the need to invest in technology. Let's not forget about the cost of talent. Can we venture a guess, or at least maybe something more than a guess, some analysis as to what, can you boil it down to a number? What do you need to have the necessary scale to compete?
Oh, I hadn't thought about it in that way, and I wouldn't put it in terms of assets under management, because that doesn't necessarily describe the capacity that you have to reinvest in your business.
It says something about how much revenue you can generate.
Yeah, so I think you need the ability. I'm answering the question now against the benchmark of you want to be around and thriving 10 years from now. Mm-hmm. I think you need the ability to cover a $100 million expense base.
Dmitry?
I think it really depends on the type of shop that you have. I mean, for us, like that would be, we need multiples of that. If you're a niche firm with a single strategy and you have an investor base that's really bought into it, not from the standpoint that this is the cool strategy for the next couple of years, but like this is really a sustainable thing for 10 years that we want to be in through the ups and downs, then you could do it smaller. But I do think that whenever we talk to folks that are starting funds, they perennially undervalue the difficulty and the infrastructure that's required. Like the days of, I'm going to have a Bloomberg and a couple analysts and a COO and we're good to go. Like you just can't compete with well-financed people that have, all the corporate access resources, the sell-side resources, syndicate, technology, risk, compliance, like the list goes on and on. So whatever the number is for that business, I would tend to err on the high side.
I think it depends on the type of business you want to run, and Dmitry runs a very wide number of strategies and needs a lot more scale than we do, but we still need scale because we still have to make the quant and data science investments, we still have to make the investments in analysts, and we have a short-only team that just focuses on shorts in addition to what the rest of the team does, longs and shorts. So for us, we run $7 billion, and that feels like scale to be able to make all the investments and evolve. I think the bigger challenge is the more you go for scale, the harder it is to keep that scale, because assets are fleeting and the industry is very fragile. And so I've been famous for saying that running a $7 billion hedge fund is an awesome, awesome business, except if you started at 20 billion. Because then you're out of business, and you built this scale for 20, and now you're at 7. And so the bigger you are, you have to have an asset gathering machine that can hold that in place. And so there's a balance here between having enough scale to invest in whatever it is that you do, and you do it well and continue to evolve, but making sure that you can hold that asset base strong and stable, because the fragility of the industry creates this virtuous circle the other way when assets start.
Well, there are ways to address that, though, other than descaling. So, for example, one of the most frequent conversations we have with our largest clients is, let's trade nominal fees, so we will lower our nominal fees in exchange for size and duration. And so now we have the confidence that the capital will be there for multiple years, 5 to 7 years in some cases. And this is not solely to invest in less liquid opportunities. This is because we and our client want to co-invest in our capabilities. And so now we have the confidence to spend $50 million a year on technology and data. And if I thought that the assets were fleeting and disappearing potentially in a year, there's no way I would make that kind of investment in technology and data. So, we talked about how the industry's terms might restructure. I think one big trend, and we're certainly pushing on this with respect to our clients, may be a better time horizon alignment and a co-investment in the business, an exchange of duration and flexibility to innovate in exchange for the capacity to use our capabilities at attractive fee levels.
Don't you just create that new issue in 5 years or 7 years from now? I know that's a long time, but locking them up and then causing them to have to make another decision for 5 or 7 years.
I think structuring your business that every one of the clients matured on the same 5-year date would be a bad idea. So yeah, we definitely try to stagger that in a way that we don't have that pin risk.
What are your thoughts on scale, Don?
I think it really comes down to strategy. So there clearly are some platforms that work way better at scale, but I would also go back to the argument that there are capacity-constrained strategies that don't want to sit on a multi-strategy platform that are really valuable to access. And the key there is that the manager is intellectually honest about what that capacity is. And they define it up front, and they define the opportunity set. And also, I think Dmitry touched on this, some of those opportunities are not going to be persistent. So you have to have that dialogue when you go into that investment and recognize that.
While we still have some time, I think it's worthwhile asking each of you what you're doing. We've talked in general terms, in some specific terms, about the things that are happening in the industry and the things that you're doing in your own funds, but a little more detail would be helpful. How are you trying to evolve? Where are you finding it challenging? What kind of pushback are you getting from your investors? Andrew, since you've probably been a little more vocal about this, why don't you continue?
No, that's a penalty for speaking up.
Or, hey, sometimes it's better to go first.
It's a joke, sorry. Well, in terms of where we've made the biggest investments as a business, over the past 4 to 5 years, we've invested quite a bit in our quantitative and systematic equity capabilities. And so that's been it's interesting. People worry about machines taking over for humans. And our experience, and I suspect it's at least as a general rule, the experience for other quantitative equity managers, per dollar of capital invested, we have more people in our quantitative businesses than we do in our discretionary businesses. They're doing different things. They're researching signals, they're researching how to get better execution, they're researching how to do better databases, how to make our computing go faster. They're doing different things, but there's more of them per dollar invested than in other areas of our firm. So we've made a very big investment in that. A substantial percentage of our capital is now invested in...
How many people are we talking about, by the way?
In terms of people per dollar of capital, in some of our discretionary businesses, it's fewer than 10 people per $1 billion of capital. In our systematic businesses, it's more than 30 people. And depending upon how you think about it, maybe more than 40 people per $1 billion of capital. So it's just it's a different, again, they're doing very different things. And just knowing a little bit about the size of some of the large firms doing it, I suspect, again, I'm sure there's some exceptions, but I suspect it's a general rule in systematic or quantitative equity investing. Where we're going now in systematic investing, our origins were in the credit markets. We evolved to be multi-strategy pretty early on in our history, but we do have deep expertise in credit, and we're starting to invest more and more in systematic credit strategies. I don't think, at least in the next few years, we'll be able to do it the way we do systematic equities because the market's not as complete or continuous, but it's an area where we think we can generate quite a bit of non-commoditized returns. I could go through each of our strategies, but at the other end of the spectrum, in private capital, we're at present investing quite a lot in resources to invest in healthcare. Because we think there's such a transition going on in healthcare. We had 10 years of massive transition in the financial industry. We're making a bit of a bet that we'll have massive transition in the healthcare industry for the next 10 years.
Dmitry.
I'd say probably the most interesting thing we have going on is along the same lines of the intersection between quantitative investing and fundamental investing. So I think when you look at different firms, and obviously everybody's trying to figure out how to go about it on the quantitative side. On billions, they have people put together a box and see how that works out to figure out the hiring. Everybody's got a different strategy. I think you have to start with what's the capability of the firm. How does that firm get an edge and compete with the folks that have been doing it for a long time? So we started it from the standpoint of we have a strong fundamental long-short business with hundreds of people and thousands and thousands of ideas all the time. That's very valuable data, right? So we started collecting that data, analyzing that data, and then giving it back to the portfolio management teams to help improve their performance and doing the Moneyball thing of finding tendencies. Then we started about 5 years ago, running quantitative portfolios off of those same ideas, using the fundamental ideas as your input, as the ingredients in the soup, but making the soup in a quantitative way, so much more factor neutral, much more evenly weighted, much more passively traded, and that's been successful over time. And the last couple of years, we've taken it from the learnings from that business and started the purely systematic long-short trading and purely systematic macro trading. And now we're even starting a new group where we have fundamental analysts to do all the fundamental work, but then just enter the ideas as opposed to discretionary trades. They enter the ideas into a quantitative trading engine, and so it separates out kind of the alpha assembly line of research and trading and portfolio management, which a lot of times the folks that are great at research are not particularly great at portfolio management, and it's distracting, and the research suffers. So we're trying to disaggregate those in one of the groups. So there's lots of things you can do with it, but I think the important thing is, how do you bring to bear kind of the capabilities of that firm to really compete and then build, off of that.
Ricky.
Yeah, so I'd say probably two areas I'd highlight. One is going to be very similar to Andrew and Dmitry. 18 months to 2 years ago, we had 16 people on our research team. Today we have about 23, and all of that growth has come in two areas. One is quant and data science, where we've used it much like Dmitry described in his first two elements, where he's diagnosing his own tendencies and using it at the individual stock rigor level, not yet to actually make investments, but sort of the concept that man plus machine is better than man alone, and it's better than machine alone. So making our fundamental team better by using the data and the capabilities of quant and data science in a much bigger way. The second area has been on the short side. I think shorting individual stocks has become a bit of a lost art. I think that the bull market has had a lot of people leave the business. I think this is an area where you absolutely need scale, because you cannot take large concentrated short positions. It doesn't work. When they go against you, they become bigger problems. They wreak havoc on your P&L, and you have no ability to be flexible. So we run with about 90 short positions, twice as many as we run on the long side. They're smaller, and to have that scale, we need not only all of our analysts to work on the short side, but we also need a dedicated short-only team that looks at things from a different lens, from an accounting lens or a fraud lens, instead of just a sector lens, which is also important. So I think those are two areas that we've been investing in over the last 2 years that allow us to continue to evolve.
Don, can you talk to us on both levels, what you're doing at Quantum and what you're doing in the way of allocating to other, like you mentioned, the amount of capital that's going to smaller strategies? I presume that's something that you've been doing as well. Can you get into some more detail?
Sure. So, one of the things that we've been really focused on is defining our competitive advantages and taking advantage of that. For us, our size and the semi-permanence of capital and the mission of the foundation we serve are clear competitive advantages. And then we've been deciding what we can do very well internally and where we can connect the dots across those asset classes and across geographies to affect a better outcome. But then there are clearly places where we think others can do a better job for us. So examples of that, onshore China. I think we'd kid ourselves that we could do that better than a Chinese national who's doing it on the ground in Shanghai or Beijing. Biotechnology, it's an area where we care a lot about, but there are some niche players there that are not, they're capacity constrained and they're outstanding, and that's also an area where it's important to us. Back to kind of the data side, it really is kind of a data arms race out there. To be competitive, you have to have good data. So we have been investing a fair amount in just our data architecture and data library. I think that's really important. One thing that I think people confuse is data and AI. I think right now where the majority of the hedge fund industry is, it's on accumulating that data and figuring out how to use it, but more in quantitative ways, versus the AI applications, I think, have yet to really materialize in a big way.
When you talk about the data arms race, it makes me go back to the point that we were debating earlier about scale. Is there, I guess it depends on what strategy you're in, and of course the amount of data available is not infinite, but where do you draw the line? And particularly at a firm like Soros, where you're operating in so many arenas, how much data is enough data?
It's interesting. And one of the other things that I think is notable is some of the data, because you have a lot of people trying to sell you data as a hedge fund right now. And one of the things is that data tends to have a half-life. In other words, it's valuable when 5 hedge funds have it, but when 50 hedge funds have it, the value drops. Although you probably want to know what it's telling people. But it really depends on the strategy. But I'd say generally, more is better when you're making decisions.
One last question for you specifically, because all 3 of your fellow panelists talked about an approach, taking a similar, I would say, not the same, but a similar approach to call it quantamental thinking. Is Soros doing the same thing?
Yeah, and I think Ricky touched on it. I think also looking at behavior analytics and recent things, everyone has a recency bias. The one thing that I think you have to be careful with is it's very unlikely what's worked. We've had a huge bull market in credit and equities for the last 9 years. It's very unlikely what worked for us the last 9 years is going to work for you going forward in the same ways.
I mentioned earlier that I'd like to get a sense of where you're finding it challenging to evolve, where you're getting pushback perhaps from your investors, and where you feel you need to educate them along the way. Who wants to take a stab at that?
I'll take a stab at that, because we've grown up as fundamental bottoms-up stock pickers where, kind of doing the traditional research and analysis on companies has been what was successful for us and for peers like us. And I actually think the push into quant and data science scares some investors for for fundamental investors, and they worry that we're changing what we do. They worry that we're no longer fundamental and we're sort of going to be beholden to a computer. And we try to educate them that we're not doing that. That the data is making us better at our jobs. That it's not just about a computer telling us to invest, but it's harnessing the power of what a computer can analyze to help the human make better decisions in the same framework he always did. But I think that that's something that gets lost with investors when they hear quant. And there are some investors who I think want to sort of put their head in the sand and say, I don't want the new world. I want what's worked because I know it worked. And we're trying to say we're doing the same thing, but we're doing it better with the advent of quant.
Anybody else encountering that conservative attitude from?
Yeah, I mean, we've definitely encountered it over the years. I think whenever you're doing something that's a little bit innovative, it's always going to sound somewhat, crazy, right? Like the more innovative it is, like the crazier it sounds. So I think the important thing from an investor perspective is you really want the firms you invest with to innovate and to adapt. I mean, we did a employee meeting a few years ago where we handed out bags to everybody that said adapt or die, right? Like if you're trying to make money in exactly the same way in long short today as you did 10 years ago, like you're definitely out of business. And I think that's across across strategies. So from an investor standpoint, I think it's important to actually encourage the firms you invest with to push the boundaries and try new things and experiment, but you have to do it in a way that's a controlled experiment. Right? Like when you do something new, you're probably going to be the worst at it when you start, right? You know the least about it. You're going to be better at it a year or two down the road, but a year or two down the road, maybe the opportunity won't be as good, right? So you have to find like the right amount of resources and the right risk allocation to start something. And as long as you can control those bets and make lots of those bets and be supportive of the managers if they don't work out, if they kept the risk to what they said they were going to do, because over time, if you invest with good people, like more of those bets will work out than not, and it creates a larger moat, around the strategies and gives them a bigger competitive advantage.
If I'm not mistaken, the word fees has only come up once or twice in the course of the conversation. I'm about to bring it up again. Can we talk a bit about this? There's obviously a lot of attention paid to fees. There's a great deal of misunderstanding about fee structures today. I think if we're going to talk about the evolution of hedge fund management, we have to talk about the evolution of fees and what they look like now relative to what they were once upon a time, 2 and 20, and what they're likely to look like in the future as this conversation between manager and investor continues. Where do we start there?
I'll take one crack at it, which is, I think, for the right high alpha generating strategies, I don't think fees are necessarily too high, but I think on average they've clearly been too high, and maybe it goes to Dmitry's point of too many hedge funds, and we haven't had as good a returns as an industry. But I think that the conversation is going to change to more of an alpha-based fee structure, even if, as Andrew said, it may be hard to define what alpha is. We're going to have to work hard to do that. Absolute return fee structures make sense if you're market neutral absolute return strategy. A alpha-based fee strategy works if you have a different construct that may have some beta. And I think there are investors out there, and Allburn's been out there with a piece, talking about paying only on alpha, and so that the beta is essentially free because they feel like they can buy beta for 3 basis points.
And I think on that, people are willing to. It really comes down to the net returns, and that those returns are differentiated, as Andrew said. And I think that investors should be flexible when it comes to fees. If they're getting a really persistent differentiated return, they should be willing to pay 30%. They should pay a lot for that. But I think the problem has been, in aggregate, the value delivered has been disappointing.
Yeah, I agree with everything that Ricky and Don said. I think there may be a trend in more transparency about the economics, the profitability or lack thereof, the capital investment of investment managers. I think the market is reasonably efficient, and the efficient equilibrium here will be investors who are seeking non-commoditized returns will have an interest in cultivating, nourishing, helping to grow investment managers who can achieve that for them. And they will be smart enough to recognize that if they don't allow them to profit and make those investments, they'll disappear. On the other hand, they will be smart enough to know they don't want to pay for value that they're not getting. So how do you square that circle? How do you resolve that tension? Just more transparency about the economics of the investment management business. This is what we're investing. This is how much it costs us to invest. This is, in general, what our compensation structure is. This is the time frame to be able to deliver those returns. Agree on what the expectations are, what is success and what is failure. And I think that's just part of the maturation of our industry. And I think it's both managers and investors will evolve. I think managers will become more creative, more flexible, more transparent in how they structure these arrangements with investors. Investors will, at least the smart and sophisticated ones, will take a longer-term view of the business.
Dmitry, what are your thoughts on the fee structure of the future?
I agree with all that. I would say that, and it is changing, I think, in the right direction. I think fee structures are becoming much more aligned. So if you think of what was probably the most unfair portion of it, if you think of somebody with a $10 billion fund and 8 people, using a very extreme example, that's probably not the world's most aligned fee structure, right? And that's obviously changing. So I think alignment is very important. I think also just like having it line up to support the type of business that you're running that fits with the mandate and gives you, both the investor and the manager, a sustainable, advantageous structure for achieving what you want to achieve, right? A lot of times you could wind up negotiating a fee lower as an investor thinking that it's really helpful to you, but if that restricts the manager from making the investments in people and systems that they need to make to put up the returns, at the end of the day, you might be worse off, right? So I think it's really important to align those types of things together.
Can we talk about I think it's wrong to try and boil down all of this to one thing, because 2 and 20 is gone, and what replaces it isn't going to be 1 and 10 and 0 and 30, whatever the case may be. But do we have a sense as to what?
I think you're thinking too simplistically, just based on numbers. I think it will be.
Oh, I know I'm thinking too simplistically.
I think it'll be more like here's a 5-year horizon. We're going to crystallize fees at the end of 5 years, but we'll pay a management fee along the way that will, be able to, the ultimate performance fees will be able to offset against the management fee. Maybe we'll have a hurdle.
Very dynamic.
But it'll be ways to incentivize patient capital to help fund the constant innovation and evolution while sharing the spoils fairly.
One last question before. Go ahead.
Allbirds put out a piece with a model they call 1 or 30, which is in effect
Texas teachers.
Which is in effect you get the 1% up front against 30% of the alpha. Now I don't think 30% is the right alpha share for high alpha generators, but the construct makes sense to Andrew's point about you get fees and then you get performance fees against it, and we have to get aligned on what we can deliver and how we're going to measure alpha,
it's just supply and demand, right? Like, so I remember when I was running a fund of funds, I really wanted to get into Renaissance Medallion Fund at 4 and 50 or whatever it was, and they wouldn't let me in, right? I'm still interested, by the way. It's supply and demand. If you're controlling capacity and you have capacity in a strategy that's high alpha and limited capacity, right? Like that has a different fee structure than something that has a ton of capacity and a lower alpha content. I think the markets over time are pretty efficient at figuring that out.
We have 30 seconds left. I'm tempted to ask, I'm not sure we can get useful answers to this question in the space and the amount of time that we have left, but I'm going to try anyway, because one of the things that we must ascertain is whether hedge fund returns are going to improve. If so quickly, Are hedge fund returns going to improve, and if so, why?
Yes, because there's plenty of dispersion in the market. We've seen capital outflow from other funds, so competition is down, and those that are left are adapting and surviving in the new world.
Don.
So I think in the excess return space or alpha, they're going to get better, but absolute terms probably lower just because we're at late stage.
Andrew.
I think over a 3 to 5 year period, they'll get better. I think we're coming out of a very tough cycle for this kind of investing. And I think we're going into a much better cycle for this type of investing. And I think there has been capital retreat from this type of investing, which sets us up pretty well for the next 3 to 5 years.
Dmitry, last word to you.
Yeah, I hope ours are.
And more broadly?
Yeah, I think so. Like, on a relative basis, I think they're going to improve because the long bias strategies, which is where most of the rest of the world is invested, I think have had a fantastic run over the last 10 years, and it's unlikely to repeat in the next 10 years. So on a relative basis, I think for sure.
Dmitry, Andrew, Don, Ricky, thank you very much. Evolution of Hedge Fund Management. Please join me in thanking our panelists.
Thanks, Eric.
Thank you.